Hey everybody, hope you guys are doing well. Welcome back to another Saturday video. This one's kind of a special one. It's a new one on me. Quite a number of you have actually sent me this fund to take a look at, and I gotta tell you, it's piqued my interest, and we'll go over it. I'm just gonna do a basic overview because I'm gonna show you how freaking complicated this thing is. Not complicated, but it's actually a huge mutual fund, right? Mutual fund. So keep this in mind that it's a mutual fund, not an ETF. So we're going off of the GW ETF. By the way, you notice the new artwork. I added retire with less GW ETF channel. I did that. Nothing's going to change. Okay. I just did that for the long-term outlook or the long-term goal of this channel. I wanted to be able to grow into that, right? Because that's what we're going to do. We're going to end up retiring with less, 5-10 years down the road. I don't know when, but I wanted the retire with less thing to go with me, right? And the GW ETF channel is still there, and hopefully one day it'll probably end up being retire with less GWRV channel. Maybe, I don't know. We'll see. But anyway, if you're new here, please like, share, subscribe, do all that good stuff. Down in the pinned comment below is a way you can support the channel. Yeah, Amazon, M1, Ko-Fi, all that stuff, right? You can support the channel and support what we do here on the Retire with Less GW ETF channel. So by the way, I don't have an RV yet. That's the goal. So those of you new here, that is the goal. Me and my wife are going to get an RV in 5 years or so. I don't know when. And we're going to hit the road and we're going to retire with less money because we started investing late. So that's like the premise of this channel, is what it's grown into. So hence the name change. So with all that being said, what do we got today? We got ticker symbol PSLDX, and it's a mutual fund from PIMCO, not PIMCO, PIMCO. And if all of you aren't familiar with PIMCO, PIMCO is actually like world-class, top-notch bond investors around. They're like the #1 bond investor in the world, almost. I don't quote me on that. I'm just saying they're like top notch in the field of bonds, bond investing. So that's their specialty. So what this is, it's a mutual fund, okay, and it's called the StocksPLUS Long Duration Fund. So it's a combination of stocks and long duration bonds and a whole bunch of other stuff. So the objective of this seeks total return which exceeds that of its benchmark. I mean, like everything else, right? Consistent with prudent investment management, and that's what these guys over here do. They look pretty prudent to me. The primary portfolio is long-term maturity fixed income. So it's mainly bonds, right? We'll go over partially some of its holdings, but it's totally not traditional. Okay, so let's just do a fund overview real quick. Let me see if I can zoom in on that a little bit. And fund overview. Taking an innovative approach to large cap investing, the fund combines active and passive management and S&P 500 derivatives options, such as futures and swaps, collateralized by an actively managed portfolio of long-term bonds. The strategy offers broad participation in the growth potential of U.S. stocks, potential diversification benefits, and access to PIMCO's expertise in seeking positive excess return. So why would you want to invest in it? So it's more than an index fund. So a traditional index fund typically invests in all of the stocks in an index. So say like VOO, it's going to just invest all in the S&P 500. It's going to buy it all. PIMCO seeks to outperform the index by employing a unique bond-centric strategy. So what they're doing is they're investing in bonds to get income and to prevent major portfolio drawdowns. So they're going to get the growth of the options or the S&P 500, but they're going to limit the downside by investing in fixed income mainly. Okay. So it does this by purchasing low-cost S&P 500 options and backing this exposure with an actively managed portfolio of bonds. So the fund offers combined benefit of PIMCO's 40 years of active bond management. So the primary benchmark is the S&P 500. The secondary is the S&P 500 plus the Bloomberg Barclays Long-Term Government Credit Index. So it's got a dividend frequency of quarterly, and I'm positive I actually haven't looked at the distributions, but in a mutual fund, if you guys don't know, they pretty much pay out all their gains in cap gains and distributions. So your share price is actually pretty steady usually. Most mutual funds start out at $10 and they usually try to hold it there. Right now it's trading at like $9.29 or something like that. But usually at the end, if it's gone up like over $10, say it's $10.50, they'll pay out 50 cents at the end of the year to get it back down to its benchmark. That's usually how those work. So let's see. You got the three guys managing the portfolio. Distribution yield as of June 30th, 2021, 19.91%. Yes, you read that right. The reason they can do this is because of the bond management. Now, when I said that they were the top-notch guys in bonds, they turn over bonds as well. They buy and sell bonds all day long. That's what they do. If they're going to make a profit, they're going to make a profit. So you can see the latest dividend on June 10th was 60 cents. And that's off of a $9 share price. So it's pretty ridiculously high. Dividend distribution year to date. So year to date, they've already paid out $1.12. And for a mutual fund such as this, usually the expense ratio is sky high. Right now, this is at 0.61%, adjusted expense 0.59%, which is actually extremely cheap for an actively managed fund. So like I said, the net asset value, $9.22. Daily year-to-date return, it's up 16%. Average annual returns, this is pretty cool. Since inception, which is 2007, I want to say, 17.37% annually. That's pretty darn good. And we're going to stick with me because I got a lot more math to go with this. I just wanted to see if there was anything else I wanted to show you on this page. I don't believe there is. Yeah, let's get off of this page because I wanted to go over to the holdings. Now, I'm not going to go through all the holdings because there's a ton of them, and I'm going to show you just a few things here. I downloaded their holdings, and it has this is from March 31st, but you can see how long this is. If I scroll all the way to the bottom, 800 holdings. They got puts, if I go back up here, a lot of investments in corporate bonds. They're really big in corporate bonds. And it'll show you what they're getting interest rates to, 4%, some smaller ones at 1.8, 5.5%. Look at that one, Barclays Bank, 10% bond there. It's a short duration one though. Looks like it expired already. Or is that that's the maturity date. So 8% in Citigroup. out to 2039. Jeez. You can buy these bonds yourself. I'm not sure if you guys know that, but we can individually buy bonds. And you go to the corporate bond side, that's where the real yields are. But, you know, corporate bonds do carry a lot more risk than government bonds, obviously, because the corporate bonds, I mean, they can go bankrupt, right? And, you know, they tell you that, you know, it's a bond, it's safe, but honestly, if a company goes bankrupt, there might not be anything left for anybody. So go down here, you got Ford Motor Credit, you know, they got they're probably investing in auto loans, GE Capital, HSBC, I mean, you name it, industrials, you got 7-Eleven, they're you know, buying bonds there. So, I mean, this goes on and on and on and on. AT&T bonds, you know, energy utility bonds here. Look at this one. I don't know who these people are, but they're paying 10%. Virginia Electric Power, 8.8%. But point is, these guys are experts in the bond market. I think most of their equity line is in options, derivatives. But yeah, I got some U.S. Treasuries. I mean, this thing just goes on and on. So one thing I wanted to look at is how are they able to get this type of return from bonds, right? Now, here's the kicker, right? Here's the kicker of this. I'm on Morningstar. I don't have a subscription with Morningstar, but sometimes you can get some information out of them, some basic stuff. And this is what I want you to see. Asset allocation, right? And we'll look at U.S. equities. Now, we got to do some simple math here, right? Because we can only have 100% in a pie, right? Theoretically. Well, here we are. We have 100% net in U.S. equities, 150, call that 156% in fixed income, and we're negative 160% in cash. So you tell me, how are they able to get this return over this long period of time? Any guesses? Leverage. So the borrowings are you know, they're able. It's just like the closed-end funds. When I you know, review closed-end funds, I talk about the leverage. This is the exact same thing, right? Except it's a little bit higher. It's like 2-to-1 almost, or something like that. It's not, you know, in a closed-end fund, you know, we're talking, you know, 10%, 20, 30%. This is a pretty high leveraged mutual fund, right? Because if you have 100% in equities, 155% in fixed income, you know, that's two and a half. Is that 2.5 to 1? Because that's 250%. So yeah, something like that. So you guys have to understand that when you're getting into this. So if you're looking at the risk here, let's look. What do they say? What does Morningstar say about the risk? They say risk versus the category is high, but the return versus the category is high. So your risk reward is high. High risk, high reward. Now, let's go back to that, because another one I want to show you is where you'd want to hold this mutual fund. Can anybody take a guess? We're super heavy in fixed income. They're paying out all their distributions and capital gains. Where would you hold this? Because we also have a reported turnover of 104%. So they're turning over their portfolio completely, almost there. I mean, at least as of March 31st, they've turned it over 100%, meaning everything has cycled through the portfolio and is gone, right? So they're constantly buying, selling, and locking in gains and things of that nature. So this is best held in a tax deferred account. Roth IRA, traditional IRA, anything that can protect you from the income this is generated. So if your plan for retirement is to live off your retirement accounts and you've been able to tax protect them, this is something that can go inside there. If you put it in a traditional, of course, everything comes out as ordinary income, so you have to play with that tax game right there. But if this was in a Roth IRA, this can be completely tax-free all the way. You just have to wait for it. So what is next? So this is what I wanted to point out, what I mean by the share price staying steady, right? It hasn't quite stayed steady, but we were talking about it issued August 31st, 2007, which is probably the worst time ever to introduce a fund, especially a leveraged one. And it issued at $10 a share back then, and it's now trading at $9.22. So a little bit of decay from this fund. But as you can see, it was the worst time for them to come out. It went from $10 to $10.50, and then 2008 hit, and it went all the way down to $4.67. So it lost over 50% in that drawdown. But what I wanted to do was look at the back test of it all the way back since its inception. And the only way you can do that, it's hard to find because I can't, my usual ETF channel doesn't do it. Most of these charts you are going to just find price to price. And we already know price to price you're down 7.8% since 2008. But like I said, mutual funds, they pay out all their cap gains, all their interest, dividends, all that stuff every single year. And so that's where it all comes from. It doesn't come from the share price. So what we're going to do is look at Portfolio Visualizer, and this is a neat tool because it'll show you a lot of information, the drawdown, the compound annual growth rate of your investment, ending balances, income, things of that nature. So I got that put in here. I put $100,000. It's going to be rebalanced annually. That doesn't matter. We're going to reinvest the dividends because, like I said, remember this over here, doesn't include dividends. It's just price to price. And we're going to see how PSLDX did versus the QQQ versus the S&P 500. Now you got to remember that PSLDX is leveraged, so you could imagine that it's going to win. So let's analyze those portfolios. And we'll look here. Portfolio 1, which was PSLDX. Your $100,000 in 2007 is today worth $899,750 for a compounded annual growth rate of 17.56%. You had a best year of 52.6%. Your worst year was 33%. And it had the worst drawdown, and that was the 2008 to 2009. So it lost 50%, but they all did. QQQ lost 46, S&P lost 48. But what I want you to notice is the worst year was 33%, which is a lot better than the 41% that QQQ lost and the 37% that the S&P 500 lost. So because of those bonds, it was able to cushion that blow a little bit. Even though their max drawdown was bigger, their worst year, so they recovered faster in that time. So even though it dropped 50%, their worst year was only 33. That year was only 33% down. Hope that makes sense. So QQQ ended up with 804,000 over time, and the S&P 500 squeaked out 390,000. So, you can't argue with it. It's leveraged, yes. It's a lot more volatile, because the drawdown, not the drawdowns. You'll see the drawdown. If we were to drop, it'll drop hard, right? But like I said, with leverage, when it drops, when it recovers better. So there's that give and take, right? If you can stomach it, the leverage can work for you, but it's hard to stomach. So there you can see the portfolio growth over time, inflation adjusted, if you want to call it, it'd be 700,000 for PSLDX and all that. So there you have it. One thing I also wanted to do is look at portfolio income. So if you can see the PSLDX portfolio income has grew what? That can't be right. Oh, I did inflation adjusted. Let's turn that off. Oh yeah, that is right. So with $100,000 invested, look at what you're getting from 2007. This income, $60,000 in 2013, $50,000 in 2014, $82,000 in 2017. 2021, you've already gotten $99,000. That's from your original investment of $100,000 back in 2007. Now that's something else. Now these returns, though, do assume that you reinvested all these dividends. But I mean, because see, watch, if you didn't reinvest the dividends, let's see how it goes. See, now that PSLDX after all this time is now only worth $92,000. But the income, you squeaked out all this income out of it. 28,000, 16,000, 10,000, 11,000. So what I thought was interesting was, let me take 200, because you know how I like to say I'm going to retire with $250,000. Let's say it was 2007 and I had $250,000 and I put all my money into PSLDX, right? And all I did was not reinvest the dividends, right? Actually, I'm going to put reinvest the dividends, and I'm going to withdraw a fixed percentage. And let's say I withdraw 6% a year, right? Now, we already know, because we know it gets a 17% annual growth rate, that 6% is going to, not even touch it, right? So let's see how it goes. So $250,000, 6%, withdrew annually. And let's see how it goes. So $250,000 withdrawing 6% every year today is worth over $1 million. So you 4x'd your portfolio, and you've withdrew 6% income every single year. So what does that look like? What kind of income are we talking about? So in the first year you got 10 grand, second year you got 11 grand, third year you got 14, on and on and on. Today, 2020, you got $55,000. Not too shabby, but that's over 12 years. Yeah, is that 12? Yeah, 12. Oh, that's more than 12. 13 years. Your $250,000 is now, you're able to pull off $55,000 a year. Interesting. So this is definitely interesting. PSLDX. I'd say if you got a lot of time, you want some bond exposure, you don't mind leverage, an affordable mutual fund is kind of unheard of. Now, some of these, some brokers won't allow you to buy this. Okay. Some of them have minimums. Some of them have front end charges. Front end loads is what they call them. That's a mutual fund thing. But there are some places that are easing that restriction and allowing you to buy it with no minimum or a smaller minimum, because this used to be a $1 million minimum to buy in, and then you had to have a minimum to reinvest or buy in some more. And I think they're starting to, unwind that a little bit. I've heard that some brokers are allowing just regular Joes to buy into this, because this is an institutional class. Usually that restricts who can buy it, but they're loosening it up. Might be available to you. Check with your broker. Like I said, this was a new one on me. Hope you guys enjoyed. Like, share, subscribe. Leave me a comment down below. You guys have a great weekend, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.